folks, Dan Frio here with your market update for March 26th, 2025. So what we're going to talk about in today's video is the hot topic all over the place. Is a recession on the horizon, and what does that mean for interest rates? So that's what we're going to talk about mainly in today's video. We are also going to go over the economic calendar, what the stock market and the bond markets are doing right now. But the big gist of what's going on right now is, are we going to go into a recession, and what does that mean for housing, especially interest rates? So my name is Dan Frio, and I'm actually a loan officer licensed in all 50 states. I'd love to be able to help you if you're out there navigating a mortgage in this market. And if you do, I'll give you all my information at the end of this video, because our slogan here is one application, one credit pool. We're going to shop your loan over 30 different lenders. Now, how in the world could we possibly do that? I'll give you all that information at the end of this video. So we want to focus in on today is, what is the market's going to do is if we hit a recession? So that's the biggest fear that we have right now. The stock market's kind of on edge with this, and so is mortgage rates. So let's get over to the economic calendar we have for today before we take a deep dive into what happens with interest rates if there's a recession. So let's get over to the economic calendar. Today is pretty light. We have durable goods orders come in today, and one was pretty much better than expected, and one was much worse than expected. So when we blend this together, I think there's just uncertainties, folks, with all this tariff stuff. Then we have Federal Reserve Kashkarian speaking. He's usually kind of in the middle. He won't say, well, we got to cut rates or we got to, reduce rates. So that's basically all we have going on today. Now, tomorrow is when all the really juice starts coming in. The PCE, initial jobless claims, and the data that the Federal Reserve really focuses in on. That's coming in tomorrow and Friday. So today we want to focus in on what a recession would look like. But let's first go over to the markets, see how the markets are reacting to basically no news out today. We'll just say it's a mixed bag of goods over here. Oil is down or up just a tad. U.S. Treasury is up a little bit right over my head. So let's get with today's topic. If there's a recession that occurs, what has happened in the past in the U.S. when it comes to interest rates? Let's focus on that today. So I actually did I'll post this video down through here, but I actually did an AI search on this to maybe help me out. So if we go over to my AI, okay, let's go through here. And then when we come back after this, I'm going to recap what the market's expected to do today, maybe tomorrow and the next day. But this is really important. What happens if we go into a recession in the U.S.? So here's what I did. I actually did a research. I went back and just went into an AI system and said, during the past U.S. recessions, mortgage rates generally tended downward. Well, my question was way up here. This is DeepSeek. If you're interested in this, it's a free service. I use it in as well as GPT, and I find this one a little bit. It'll tell you it's thinking, which is kind of cool. So I put it in here. What did interest rates, and specifically in mortgage rates, do during recessions in the past in the U.S.? So it goes through all this thinking. You can read it. It's intriguing. It tells you what it's thinking, goes down through here, gives you examples, everything. And then it concludes at the bottom right through here. It says, now let's focus in on this, because everybody's worried, if we go into a recession, a massive recession, what's going to happen? The whole world's going to crash. Well, let's go back in history and see what exactly happened in the past during past recessions. So in the 1980s, there was a recession, and mortgage rates went all the way up to 18.6%. Now, you guys are saying, okay, you guys back in the 70s, 80s, 90s, you had it really good because mortgages were, they were cheap, and they weren't as much as they were today. Imagine paying 18% on your interest rate on your mortgage. Just let that sink in a little bit. I don't care what time frame you are in history. An 18 or almost a 20% interest rate on anything is absurd. Okay, but that's what happened in the 1980s. Okay, so are we going to be concerned about rates going up to 18%? I don't know. Let's check. 1990 to 1991, what happened? Well, rates declined, and they were about 8 to 9% during those time frames. And again, look at these rates, folks. You think today's rate at 6% is bad. 18 or 10, not that great. Okay, but here's what happened. Context: triggered by the savings and loan crisis and oil price shock. You notice oil has a lot to do with a lot of different things that we've had issues with throughout the world. This might be another reason why we might want to be dependent on energy. Just saying. You'll get a trend through here. Okay, so that's that piece of it. If you go up through here, again, high inflation led by Federal Reserve raising rates. Caused severe recessions. Okay, the rates declined and so forth. So let's go down through the next one, 2001, the tech bubble. What happened with mortgage rates? Well, they dropped from 8% to 6.5%. So that's basically where we are right now. Look at that. 2001 is basically where rates are, and we're still there today. Okay, not a bad again, it beats 18%. Then we go to the 2008 global crisis. This was basically by what caused it? Subprime mortgages. And a lot of people don't believe me. They're like, no, there's a lot of other issues. Guys, it was basically from subprime mortgages. That was it was a catastrophic event throughout the whole world, believe it or not. Okay, mortgage rates initially spiked, and then they went down all the way to 4.5%. Man, I wish we can get back there now. And then COVID, what happened during COVID? Now, this is the culprit why everybody's locked in at their rates today and why nobody's moving, why there's no houses available. Here's what happened. During the recession, Federal Reserve cut rates basically to zero. Okay, almost to 0%. What happened? Rates hit historic lows at 2.7. I have a 2.7% mortgage on my house. I'm not looking to move it anytime soon. Even if it was like, oh, should I move? It's like, man, my house payment is so nice, and I have a nice home, and I just like it. So the rate that I have is equal to a lot of people out there, and we're stuck in our house. And I don't want to say stuck. I love it here, but I have no intentions of moving because I don't want to trade in my 2.7 rate for a 6.5 or 7% interest rate. That's me. And that's what a lot of people in my situation are doing. They're just like, okay, we're good. Taxes are going up, homeowners insurance is going up. I don't want to now couple that with getting a new mortgage at 2 or 3 times what the rate is that I have today. So that's why a lot of people are just staying still, and that's why we don't have much inventory out there. And they keep saying, well, construction. Well, yeah, but we've never been in a locked-in effect like we have today where people they don't move. People have a 2, 3, 4% interest rate, and they're like, we're good. So that's what's basically happening right there through there. General trends. Now let's go down through here. This is the important piece of the puzzle. General trends is right through here. Federal influence. Short-term rate cuts in QE during recession typically reduces long-term treasuries, lowering interest rates. This is exactly what happened during COVID. Okay, so how did rates get down to basically 2%? What the Federal Reserve did, and this is intriguing, and you have to know this to understand how all the markets work, is the Federal Reserve came in and they started buying up all the bonds, buying up Treasury bonds and buying up mortgage bonds. Let's go over to this so I can show you what's going on. Well, the MBS right now is taking a hit. It's down 13, so mortgage rates are going up. But here's what it looks like. So when they say, go back through here, when they say down through here, QE during recessions. So what happened is during these times, the Federal Reserve came in and they started buying up the markets. Okay, so one of the markets they bought up was mortgage-backed securities. Okay, this is the bond that trades on Wall Street that determines your interest rate. So if somebody goes in here and they buy up the market, they buy, what's happening to the prices? Well, they skyrocket. Not like they're doing right now, but they go up, and up. Okay, so what do we know when a bond price goes up? Well, rates come down. Okay, so the Federal Reserve, let's go back to here, see if I can look at this. And if I can go back to here, here's when interest rates are, when the chart's up here, interest rates are low. When the charts are down here, interest rates are high. Look how high that is. And that's in 2021. If I can go back, let's see how far in history we can go. Can't go back all the way to there, but look through here. I mean, this is where we were, okay, and down through here, but prices are up. Rates are down. And then this is what's happened over the last couple years. And it's down, and away. I can't go back to 2008. That would be intriguing because that number would be way up there. Okay, so that's what we're seeing in those times right through there. So that's what we're focusing in on when it comes to the recession. So let's keep going with this. Investor behavior, flight to safety. That's another thing we've been talking about, buying bonds. So during a recession, what most people do is they sell off stocks because they're like, okay, the market's going to get soft. Consumers are going to stop spending. And what's going to happen? Well, corporate profits are going to go down. Thus, the stocks are going to go down. So people are going to move their money into safety. And we talk about that a lot on our videos. We talk about, flight to safety, why the stock market's crashing and interest rates are getting better. Right through there. So that's what normally happens. And that's why I always tell you too, in history, when you look back, when you see the stock market really rallying, you'll see bonds doing pretty bad. And then on the flip side, when stocks are crashing, you'll see people buying into bonds and the bond market's doing really well. So in this time right now, people are just teetering on the fence. It's like, okay, are the tariffs and inflation and a recession coming going to hurt the economy? So thus, should we flee to safety now, or what should we do? So we have days and pockets of days where people are fleeing to safety and moving their monies, and I call that out on my videos. So pay attention when we're talking about that, because that is a big point when it comes to interest rates. Okay, So investors' behavior during a crisis push yields down, further reducing mortgage rates. Exceptions: inflationary pressures. In the 1980s, high inflation kept rates high. Credit crunch during the 2008 crisis, mortgage rates barely rose due to rising risk from the Federal Reserve. Conclusion: mortgage rates in the U.S. have generally declined during and after a recession. So if a recession's on the horizon, don't freak out, folks. You might want to move some of your money out of the equity markets into bonds, because a lot of people might be fleeing to safety if we do, in fact, hit a recession. So that's your recession, basically history for today. So let's get over to the markets once again to do a recap. Mortgage rates are up just a little bit today. They're going to continue to rally because the bond market right now is taking it on the chin. Let's get to where the bond market is right now. It's down ticks. There's a little blip right through the radar. I'll take a look at that, and I'll get back with you at the closing bell to see what happened potentially there. But right now in the markets, the economic calendar, really nothing out there today other than durable goods orders. We have Kashkarian speaking. He's one of the Federal Reserve members. Not really concerned about him. He doesn't come in and really freak out the markets. Stock market right now in equities, Dow Jones is up, NASDAQ is down. Oil is still below $70 a barrel. We're cool with that. When we go over to, let's check crypto. What's crypto doing? It's down $345. This was $106 about a month ago. So that's crazy. The MBSs right now are down 10 ticks. That means mortgage rates are going to continue to go up. Let's see what they did yesterday. Right through here is we called a top on the day. And then from there, I requested a bunch of clients to lock in. Some did, some are hesitant, and here's where we're going from here. And remember, when this goes down, this isn't rates, this is the bond price. And when this goes down, rates go up. So that's what's happening right now in the markets. So right now, if you go over to the CME FedWatch tool to see what the heck the Federal Reserve is going to do in 42 days, what are they going to do? Well, they're really not going to do anything. I'll break it to you now. There's an 87.8% chance they're not going to do anything. But the June numbers are now looking more favorable. Over a 60% chance the Federal Reserve will cut in June. That's what we have in the markets right now. So that is my report for today. My name is Dan Frio. I hope to be your nationwide mortgage loan officer, with our slogan here is one application, one credit pool. We're going to shop your loan to over 30 different lenders. Now, how do we do that? Well, I'll break it to you. I actually work at a federal bank, and that's what gives me my federal license throughout the whole country, as well as Puerto Rico. But the cool thing is we set up also with 32 or 33 other lenders right now. So here's what it is. We want to be your one-stop shop. So instead of going out there and shopping around and putting your application in everywhere, why not just come to us? Because we're going to shop your loan to over 30 different lenders with one application. So how do you get started? We just go to the rateupdate.com. You can get started right up through here. You can put in your application, just hit the apply now button, or you can schedule a consultation. That's in case you're just reluctant. You don't want us to run your credit, or you just have some questions. Well, schedule a consultation with us. We'd love to have you do that, or give us a call. Just scroll down to the bottom of the website and you're going to see our 800 number as well as my email address. So give us a call at 844-775-5626 or email me personally at dan@therateupdate.com. Give me your story. Let me know what you need help with. Be more than happy to reach out to you, answer any questions, and get you started in maybe home ownership or maybe saving you some money on a refinance. So thanks for watching, folks. God bless. Have a fantastic day. I'll see you here at the closing bell. But don't forget, we will be live today at 3 o'clock where I'll be answering your questions. How much can you afford with the salary that you have? Stay tuned. Check it out. I think you'll be surprised on some of the numbers. Have a great day, folks. Bye-bye.